Good morning, ladies and gentlemen. And once again, a very warm welcome to the Asian Banker Future of Finance Summit 2023. The theme of this year's summit is Bridging the Gap, where the confluence of traditional banking and DeFi meets. To formally start the event, let us welcome Mr. Alain Chevalier, Chairman, Future of Finance Summit Advisory Council, for his welcome note.
Ladies and gentlemen, dear guests, first I wish you a very good morning and a very good conference. It is with great pleasure that I welcome you to this 24th Annual Future of Finance Summit here in Bangkok, in this energetic city. Our theme for this year's summit is Bridging the Gap, where the confluence of traditional banking and DeFi meets. It's very optimistic. And this mirrors the spirit of the city, which is a vibrant fusion of tradition and innovation. We find ourselves at the cusp of an era of transformation and disruption, with unparalleled opportunities on the horizon. As we delve into a future of finance, there is no more fitting backdrop than Bangkok, a city that stands as a model of global urbanization, striking a perfect balance between the old and the new, from leading the charge in blockchain and artificial intelligence-driven finance to preserving its stunning temples and cultural heritage. The Future of Finance Summit over the last 23 years has earned a reputation for gathering the brightest minds, innovators who challenge the norm, ignite intense discussions, and explore the critical issues shaping our world. This year, we have the honor of welcoming Sir Howard Davies, Chairman of NatWest Group, founding Chairman of the Financial Services Authority, UK, and Chairman of the International Advisory Council of China Securities Regulatory Commission. Sir Howard, a luminary in global finance, is set to share his invaluable perspective on the future of finance in an increasingly digitized world, the challenges of geopolitical conflicts, deglobalization, and the threats posed by climate change to global economic growth and the world order. Dear participants, honored guests, returning to the dynamic of Bangkok, of the city of Bangkok brings joy and inspiration. The city's warm hospitality, generous support, and our partnership with the Thai Bankers Association have been instrumental in making this event a resounding success. And now it gives me the immense pleasure to introduce a significant figure in Thai banking industry, board member of the Thai Bankers Association and the president of Bangkok Bank, Mr. Chartsiri, Sophonpanich. Please join me in extending a warm welcome to Khan Chartsiri as he takes the stage for this welcome address. Thank you very much and have a nice day.
Thank you very much. Sir Howard Davies, Mr. Barney Frank, Sir Alain, Chevalier, Mr. Theo Presley, Emmanuel, Daniel, distinguished guests, ladies and gentlemen. Welcome to the Asian Bankers Future of Finance Summit 2023. It's my honor to provide this opening remark on behalf of the Thai Bankers Association. It is a pleasure to see so many esteemed colleagues here at this prestigious Asian banking event, which brings together leaders and pioneers from across the global banking and finance industry. Today is the first Future of Finance Summit since 2019, so this is a very special occasion for all of us. While the COVID pandemic disrupted the way we live and work, it did not stop us from doing business. The fact that we have some 300 people across more than 30 countries with us today is testament to our commitment to being forward-thinking and strengthening our industry. I cannot think of a more appropriate topic than this summit's theme of reimagining the financial institution of the future. I'd like to thank Emmanuel Daniel, founder of the Asian Banker, and his team for curating such an impressive event, which features some of the world's sharpest thinkers on issues ranging from risk management and regulatory changes to leadership, morality of capitalism, the next financial crisis, and the post-5G world. We will also hear keynote addresses from Mr. Barney Frank, former congressman and co-author of the Dodd-Frank Act, and Sir Howard Davies, chairman of NatWest Group, chair of the International Advisory Council and China Securities Regulatory Commission, and former chairman of the UK Financial Services Authority. I mentioned earlier how we had all been disrupted by the pandemic. It was not only disruptive, but transformational, as it sharpened our focus on issues such as digital transformation, the rise of exponential technologies, ESG, evolving regulatory environments, new ways of working, and challenging customer behavior. These factors are transforming our industry and making us challenge our traditional practices and ways of thinking. During the COVID years, all of us had to accelerate our digital transformation processes so we could respond rapidly to changing customer needs and adopt more flexible ways of working. Now, more other changes are coming, as the Bank of Thailand is about to issue Thailand's first digital banking licenses, increasing the competition from non-banks and technology companies. While this will be challenging for us, it is also an opportunity to evolve and develop new ways of doing things, provided we maintain our focus on to best serve our clients and customers. This competition should be beneficial as we will force us to adapt and innovate. And in my view, one of the best ways to do this is through working closely with other banks, fintechs, regulators, and customers. One of our most successful collaborations in recent years is the introduction of PromptPay, Thailand's national digital payment system, which was developed at the initiative of the Bank of Thailand. PromptPay has not only transformed the payment business in Thailand, it's also now providing a platform for regional digital connectivity and financial interoperability across ASEAN. Customers are now making cross-border payment using local currency and QR codes between Thailand, Vietnam, Singapore, and Indonesia. It's great for tourism and supports small businesses. The Bank of Thailand is also working with our central banks on initiatives such as digital currency, to develop central digital currencies to facilitate more efficient trade, payment, and settlement. The Thai Bankers Association is collaborating with government agencies, regulators, and other parties to ensure we develop best-in-class cyber risk threat detection and defense system as well as to construct a robust and resilient national digital financial architecture and infrastructure that can serve customers seamlessly and securely. I've spoken about innovation and customers, but the impact of our business is much broader than this. How do we do business has become a critical focus for all of us here today, as we need to ensure that we banks and our partners across our value chains operate in a responsible, sustainable manner. Last year, the Thai Bankers Association signed our ESG declaration to set the banking industry's clear direction in addressing ESG, while raising awareness on sustainability among stakeholders and driving the Thai economy to a sustainable growth. This affirms our members' commitment to sustainable banking, outline commitments in relationship to climate change, diversity and human rights, financial inclusion and reduced inequality, while fully supporting Thailand's smooth transition towards achieving UN's Sustainable Development Goals and its commitments to the Paris Agreement. Signatories agreed to focus on 6 priorities: governance, strategy, ESG, risk management, financial products, communication, and disclosure. To conclude, while we will spend much time talking about the impact of technology on our business and customers, we must remember banking and finance has always been a people business. Technology can deliver many efficiencies and innovation, but our future will depend on how we use it wisely to provide the best possible human-centered services and advice to our customers, employees, and communities. I wish you a very stimulating discussion throughout this important seminar and a very successful meeting. Thank you very much.
Thank you, Kun Chartsiri. Ladies and gentlemen, let us now welcome Mr. Emmanuel, the founder of the Asian Banker and Guardian Gaita, member Advisory Council Future of Finance Summit, on stage for the for the opening remarks. Thank you.
Good morning, everybody, and welcome to yet another exciting Future of Finance Summit. This is the first summit after the pandemic, and it's great to be able to organize this event here in Bangkok. As all of you know, this is the part of the show where Guardian and I disagree publicly on just about everything. Would you like to say a few words?
I agree with that. I agree with you. Welcome to everybody.
I thought I'd start the morning by putting a small plug for the fact that I published my first book, The Great Transition, The Personalization of Finance is Here, last year in October in New York. And it's very interesting to see how some of the ideas that I put together are gaining currency in the industry. In fact, if you put up the slide, I'd just like to encourage you to get a copy eventually, and Barney and I would be available to sign the copy. Barney wrote the foreword for the book. We don't necessarily agree on everything, which is why we are great friends. And he gave his perspective on where the industry is heading. The ideas that I have in my book range from the transition of the platform industry to personalization, and there are a few themes that I've added in the book. Can we have the slide up? It's okay. So those of you who get a chance to get a copy of the book later, please do so. And we will be discussing some of the themes in the conversation that we're going to have this morning. And we have this morning an incredible panel representing some of the thinking at global level on a whole range of issues, from regulation to the incorporation of new technologies, way past beyond the platform economy into AI, and what AI is doing to society, but also how the financial services industry should respond. At this point, can I invite our distinguished panelists and speakers to come on stage and take their seats. Let somebody come up to usher them to their seats. And while they are being ushered to the seats, Gordian, give us a sense of what we will be discussing this morning.
Okay.
Or what's at stake.
Well, again, welcome. And let's revert back to the conference from your book, which of course is the reason we're all here, so we can talk about the book. I think that I've been here with Emmanuel maybe the last 20, 25 years opening that. But in the past 2 decades, things were pretty conventional. Recently, every year we have a new buzzword or a new financial structure or a new network or a new technology that has the danger or the opportunity of disrupting. As you know, danger and opportunity are probably the same thing. They just have a different sign and a different outcome. And that is exactly what we're going to talk about today, this morning, is how we can manage the threats and the opportunities that are presented by all new forms: decentralized finance, crypto finance, virtual finance, and all the tools that are supporting that. At the same time, some cracks are emerging, and we can see that in the United States. So we want to talk today about how can we collectively manage this challenge. And I think Chartsiri said that very elegantly, said we can't avoid technology. I mean, we couldn't avoid replacing horses with cars, and we couldn't avoid replacing hand labor with machines, and we will not be able to avoid replacing banking to some extent with technology. The key is how we use it and the advantages, and today's panel is uniquely positioned to comment on that.
Let me add to that. Around the region more recently, there have been, an upsurge in fintech conferences. And they've been taking us in a different direction, in that fintech started by proposing to disrupt the banking industry, and what we see happening today is many of them are now applying to become banks themselves. And in fact, the digital banking licenses being issued in many of the different countries are absorbing the fintech energy back into the banking industry. At the same time, there is a parallel development in decentralized finance. And the banking industry started by being suspicious and dismissive of the developments taking place in the industry. Now, coming from the banking industry, as we do, the traditional industry, we had to wrap our minds around how that confluence might eventually happen. And I believe, and I say this in my book, that the confluence has started to take place. Now, we want to be able to capture some of the dynamics of that confluence at the regulatory level as well as the technology level. So without any delay, my good friend Gordian, please introduce the keynote speaker for this morning.
Thank you. Ladies and gentlemen, it is indeed a great privilege and a pleasure, hopefully for all of us, to introduce our keynote speaker, who just arrived in the nick of time, just this morning. And his CV is so long and so full of illustrious positions that it would take all morning to read. So I will just restrict myself maybe to a few key points. Sir Howard Davies was or is the chairman of National Westminster, as you know, bank, as you know, Royal Bank of Scotland, was renamed National Westminster, and he's the chairman. He's also a former director of London School of Economics. I mentioned these two things because both of them are close to my heart. And I would also like to say he was a consultant at McKinsey. Some of you know I was a partner at Booz Allen, and therefore I have to mention that. But he was the first founding chairman of the Financial Services Authority in the UK. He's chairman of the advisory council of the Chinese regulatory authorities. And so he has a very illustrious career, as he said, in banking, in regulations, and in UK government. He was an advisor to the Secretary of the Treasury. He was a chairman of the Airport Commission, and he has innumerable activities on that front, and he was, for that, he was knighted. So it is really a privilege to have you here, Sir Howard. Thank you very much for coming. I know it's a long flight here, and it's certainly warmer than in the UK, so that changes. Please join me in giving a very warm welcome to Sir Howard Davies, who will deliver the keynote address. Sorry? Yes. These should come up as you call.
Thank you.
No,
Thank you.
Somebody will give it to you in the clicker.
Thank you. Well, Gordian, you're wrong about the weather, because the weather in London is almost exactly the same for once as the weather here. It was hot and muggy. I mean, it's fashionable these days to talk about deglobalization, but in weather terms, there is perfect globalization, I can tell you, between London and Bangkok. It's exactly the same. I'm only here for a couple of days, which is as much as one can be out of the UK at the moment, because if I were here for longer than that, when I got back, there'd probably be a new government because we change them pretty frequently. I've been asked to do something quite challenging this morning, because I was asked to talk about the recent turmoil in banking markets in North America and in Europe, of course, but also to talk about some of these longer-term challenges to banks coming out of neobanks, fintech, AI, etc. So the only hope I've got is that I'm going to talk quickly and using a certain amount of shorthand, because otherwise I've got no chance. But I'm conscious that everything I say will be pretty headline nature, and I'm sure that in the discussions afterwards we can get into somewhat more detail. We have been moving in the banking world in the Northern Hemisphere through a pretty turbulent period, and that's true both in the US and in the EU. In the US, I'm not going to talk in great detail because I've got Barney Frank here, who of course knows more about the US banking system than most people have ever known. And so I'm sure he will give us some detail. But let me just say a little bit about what has gone on there and the implications, particularly for the rest of us. The US collapses began, of course, with Silicon Valley Bank. Curiously enough, I knew the bank because NatWest had an office in its building in San Francisco. Actually, we were dealing with relationships with various fintech companies over there, and we were there. And I met the chairman about 3 years ago, who told me very politely that he was the future of banking, aligned with the clients, focused on a particular sector in, of course, a fast-growing economy, and that it was nice to meet me, but I was a dinosaur and reflecting the old business model, which would no longer work. Now, the future, of course, the future of banking turned out in that case to be bankruptcy, and the Silicon Valley Bank and the others together were failures on the scale of 2008. I mean, this shows the total balance sheet size of the banks that failed this year and what happened in 2008-9. Now, why did this happen? Well, I can't give a full answer to that, and probably we've only got the first draft of history so far. One, of course, is there are still rather a lot of banks in the United States. There are 4,200 banks in the United States versus 311 in the UK and 220 in France. But clearly there were issues involved in the supervision. And the Fed reviewed its own supervision of, I'm just trying to work out which one of these things I do. Do I just do that? No. The green one. This one at the top. Brilliant. Thank you very much. The Fed produced its own review of the supervision, particularly of Silicon Valley. They, of course, blamed the bank, which must be right, including the board, whose risk management was clearly deficient. But they also blamed their own supervision, saying that supervisors failed to take forceful enough action. They didn't appreciate the vulnerabilities of the bank's business model. Now, this is interesting, and no doubt there will be changes in the way the Fed operates in the future. But I guess for the rest of us, it's more important to see what lessons there might be for supervision generally. And how far is this relevant to Europe or indeed to Asia? Well, you may say in a direct sense, quite little, because the particular issue in SVB of an interest rate mismatch is not one that applies in the UK, certainly, or in the rest of Europe. We do have the supervisors do stress test for interest rate risk in the banking book, for example, which is not typically the case in the US. We have capital add-ons for interest rate risk in Pillar 2 in the UK. There isn't such a thing in the US. So in some ways, you may say this is a particular US issue, but it has reignited the regulatory debate. There are those, particularly in the academic world, as some of you will know, who are always arguing for more capital and more liquidity, and they've been emboldened further. But there are, I think, likely to be some implications. Not, I think, because there are other European banks in a similar state. There was some extremely unhelpful commentary from Hank Paulson in the Financial Times suggesting that there aren't any problems elsewhere in the US, but there'll be a lot of focus on Europe, where financial institutions aren't as strong or as well capitalized as they are here. This is a very, very peculiar observation, because if you look at, for example, liquidity, if you look at the liquidity coverage ratio of US banks versus European banks, it is radically different in precisely the opposite sense. But I think this is not particularly helpful to have people saying, oh, there are problems elsewhere. Investors have not taken that view, and investors have looked through what has gone on in the US and compared it elsewhere. And the regional bank index in the US has dropped sharply in relation to the European bank index. So investors have looked through all of that. So what will be the implications if these are somewhat red herrings, I think, the liquidity point particularly? Well, in the US, of course, there's one rather peculiar feature, which is that JP Morgan now seems to come regularly to the rescue. And this takes one back to the days before the Federal Reserve was founded in 1913. Because in the absence of a central bank in the US didn't have a central bank until 1913. Well, they had two previous attempts to have a central bank which didn't succeed. And frequently, JP Morgan himself orchestrated rescues in his study in the Morgan Library on Madison Avenue. And of course, frequently, some of the benefits of the rescue stuck to his fingers. And we've now come back to a position where JP Morgan is in some ways acting as a kind of rescuer of last resort. And what we've therefore seen is that the share of deposits by JP Morgan has got higher and higher. And this was one of the lessons for the last financial crisis, was that there should be some cap on absolute bank size, which was actually appeared under the Obama regime, but that now seems to have had to be abandoned. So that's one rather curious consequence in the US, but what about the regulatory consequences elsewhere? Well, it's pretty clear that in a number of countries, the deposit protection limits and the ways in which deposit protection are funded are now under review. That's certainly true in the UK, and it's certainly true in the European Union, because what happened in the US, the prospect of a lot of small businesses, particularly rapidly growing high-tech businesses, being unable to access their money for some considerable period if the bank failed, was clearly one that was not politically acceptable in the US, and I doubt if it would be in many other countries as well. So it seems quite likely that there will be some changes to deposit protection arrangements, and that could be somewhat costly for the larger banks, I fear. I think it's very likely that we will see some changes in liquidity outflow assumptions. Frequently, people will say this was the first Twitter bank run, but that may or may not be quite a good way of describing it. But what we can see is that the outflows from these US banks were very rapid over a very short period of time. A moment about the speed with which deposits could flow out of your bank, they are out of date. And I would have to acknowledge that's true in our case, and it's probably true in yours. There are certain assumptions about how quickly sight deposits could leave, etc. And that can clearly be much more rapid. So I would expect, and the Basel Committee is already beginning to look at this, I would expect that we will have some tightening on liquidity. I think on capital, the Fed is likely to be somewhat tougher on Basel 3.1 than it was going to be. Actually, the Bank of England has been very tough on the implementation of Basel 3.1, so I don't think we're going to be affected, but it may well affect some other countries who have been waiting for the Fed's lead. So I think in all of these cases, it looks as if we will see some broader implications, and we all need to be preparing for that. Now, I've focused a bit on the US, but of course there was another big problem, and that was with Credit Suisse. The Credit Suisse failure, though, was a much more slow-motion car crash. I mean, this had gone on for a long time. If you looked at this Credit Suisse market capitalization versus the other significant investment banks, it had been in relative decline for really quite a long period. I would argue that that was about the business model of Credit Suisse rather than about anything to do with capital. And indeed, if you look at Credit Suisse, and this maps where the insured deposits as a percentage of total deposits on the x-axis and reported return on book value on the vertical axis, you can see that Credit Suisse was in a place where no one else was, and where no one in this room would wish to be, with very vulnerable deposits and a very low return on equity. And so this was a bank whose business model was, in my view, fundamentally unviable. And it was therefore likely at some point to fail. There is an interesting question, which is now extensively debated in Europe, as to whether the Swiss regulator should have intervened earlier. I've got my own view on that. But undoubtedly, this was a different type of issue, even though the deposit outflow did accelerate in the last quarter of last year. Now, what are the consequences of the Credit Suisse failure? Well, there's been some disruption in the AT1 market, and the Swiss method of resolving Credit Suisse, or knocking it into UBS, upturned the normal creditor hierarchy. And that created significant disruption in the AT1 market in Europe for a while. But interestingly, the Bank of England and the European Central Bank intervened very quickly to say that they would not do such a thing, that they would not invert the creditor hierarchy. And in fact, as a result, the market has stabilized really quite quickly. We made a significant AT1 issue last week at very fine margins, and the disruption in that market now does, outside Switzerland, appear to have disappeared. In Switzerland, of course, there'll be litigation on this topic from now till the end of time. There is more concern, however, about the implications for the recovery and resolution regimes. The Swiss finance secretary said, "I've come to the conclusion that a globally active, systemically important bank cannot be wound up according to the too big to fail plan." That is a pretty fundamental statement. And all of us in this room who are significant banks will have gone through the agonies of producing a recovery plan and a resolution plan. Ours is feet thick, and we believe it's a realistic plan, and so do our regulators. And yet the Swiss just swept all that aside and said it didn't work. In fact, I think the Swiss made a choice to resolve Credit Suisse in the way they did by knocking it into UBS. It could have been done in a different way. And it's very unhelpful, I think, that the whole resolution regime should have been thrown into doubt. And the regulators, I think, are now trying to reassert the viability of recovery and resolution, because it really is quite a fundamental part of the global regulatory architecture. And unless we can restore the credibility in that, then I think we do have a problem, because this is rather an important building block of international regulation, which has been thrown into doubt by the way in which the Credit Suisse problem was dealt with. So my view is that there are some implications of what's gone on from the US and Switzerland. They are still not totally clear how they will be resolved. Basel is looking at it. I think we can expect tougher liquidity rules, and I think we can expect some overhaul of the resolution and recovery, and I think we can expect some changes to deposit protection. None of these absolutely fundamental, but all in some way costly. Now, looking at the slightly bigger and longer term picture, what we can see is that if we take the evolution of the global banking system over the period since 2006, we see some pretty striking things, which is that on a market capitalization basis, US and particularly Canadian banks, I mean, the unsung heroes of the last 15 years have been the Canadian banks, whose market capitalization has increased absolutely dramatically. As you can see, the market cap of European banks has fallen during that period. Asian banks about flat, but it's North American banks and particularly Canadian banks who have done extremely well during this period. On an asset basis, well, Asian banks' asset growth has been dramatic, but the investors don't seem hugely impressed by that because the market cap has not responded to the growth in assets. So there are some interesting questions for us in Europe and in Asia to answer as to why it is that growth is not being reflected in the market appreciation of the value of these franchises. If you look at the league tables on big banks, well, the Asian banks have grown. Sadly, going back to December 2008, my bank was the largest bank in the world, and we chose to be the largest bank in the world at precisely the worst moment to be such a thing, because it was the moment before the major collapse. And so we have disappeared, are dominating. And on the brand values of banks, which is a calculation that the Banker magazine produces, the Chinese banks and US banks are the ones whose brand value appears to be growing and appears to be very robust. Before anybody in the room decides to congratulate themselves on this, I should point out that in 2022, one bank grew its brand value by 148%. It was trumpeted in the Banker magazine as the fastest growing bank in the world in terms of its reputation and its brand. And that was Silicon Valley Bank. So we have to be slightly cautious about some of these league tables. What's perhaps more interesting is what we can see from the price to book. So these are lines, you don't really need to see the numbers terribly closely, but at the bottom are the European banks, where on average, they're at about 0.7 book. The Asian banks are at 1.2 book, and the Canadians are at the top of this league. So Asian banks doing somewhat better with investors, but not dramatically so. So at the end of this period of turbulence, we're left kind of where we were, with banks undervalued according to investors, with the price to book low, even though, according to the ECB, we've now come out of this crisis. This is the ECB's overall stress indicator, which peaked earlier this year, but has now gone down into, as it were, safe territory, according to them. This may not be right, but it's as good as we can find as a systemic risk indicator for the European financial system. But of course, systemic risk, liquidity, and all these traditional banking things are not the only things we need to worry about at the moment. And there are a whole series of other challenges which, over a longer period, are threatening the business models of the banks for which we work. Obviously, the neobanks and the fintechs, there's blockchain and cryptocurrencies. Blockchain more relevant probably as a piece of technology than cryptocurrencies themselves for banks. And then the big topic of artificial intelligence. And all of these things are increasingly preoccupying bank boardrooms around the world. If you look at what the implications have been over the last decade and look at the market value of the top 20 firms in each category, you can look that banks were 80% of the total market cap of banking, payments, information providers, and fintechs in 2012, and they're now 50% of the market value of these companies. And that is a pretty dramatic change over a decade, and there's not a great deal of sign of it changing, though it is fair to say that the trend in investment is changing somewhat. What we can see is that these neobanks and fintechs have taken vast numbers of customers. That's particularly been true in a place like the UK, where we have, I use this word in the sort of traditional dictionary sense, we have promiscuous customers in the UK. And we have a lot of people who are very happy to try something new and don't exhibit a huge degree of loyalty to their traditional providers. And that's not just true in banking, actually. I mean, it's true frequently, you can find people will start a new beer, they launch it in the UK because people will try it, in many places, you try to launch, a new beer in Germany and they go, what? I've been drinking this beer from my local brewery for the last 200 years. I'm not going to try something else. Whereas in the UK, Thai beer, for example, took off in the UK well before it took off anywhere else in Europe. And it's the same as true in banking, that people like Revolut, Monzo have accelerated in their customer growth really rather rapidly. None of them have yet made any money. And some traditional bankers will say, well, there you are, this will never work. But then after 10 years, Amazon hadn't made any money. So I don't take too much comfort from the fact that they are not making any money at the moment. But it is the case that the investment in fintechs, and this is the sort of global figures in US dollars on venture funding in fintech, have come off the peak. So the peak was into 21 and does appear to be falling back. Now, there's still a lot of investment that went in, which will be aiming for some exit. But at the moment, it appears that the cycle of investing in fintech is on the way down. But then AI finally is the biggest challenge. I mean, a huge technology breakthrough. We have in Theo an expert on AI on the panel, so I'm not going to try to summarize it myself in any great detail, but undoubtedly it is posing a huge challenge. Just a quote from Andreessen Horowitz saying the potential side is hard to grasp, somewhere between all software and all human endeavors, which is a reasonably large range of possibilities, I think. If you look at it from a banking side, you know, the one way we like to think of it is the way in which it impacts on digital wallets, on cryptocurrencies, on the way we use the cloud, indeed on all our customer-facing activity, these implications could be absolutely massive, I think. Some aspects of it are relatively easy to see. We can see that the implications for productivity could be massive. And a very recent report by Accenture tried to look industry by industry at the percentage of functions that could be replaced quickly by AI. And interestingly, they calculated that 54% of all functions in banks could be replicated by AI. And that was the largest of any industry sector. For example, in utilities, it was 20%, etc. So their calculation is that banking is the most susceptible to AI of all industry sectors. Now, there's good news and bad news in there. The good news is, of course, that there are huge potential productivity gains in a lot of customer-facing activity, but of course, that is also a threat to the business model. Because if you don't get ahead of it, then you could be facing competitors who have a massive productivity advantage over you. So this is something that we are rescuing with. Now, can we deal with it? Going back to my dinosaur analogy that Silicon Valley Bank kindly gave to me, the picture's pretty bleak, gentlemen. The world's climates are changing, the mammals are taking over, and we all have a brain about the size of a walnut. Is that the case for everyone in this room? Hands up whose brain is, sorry, I should ask that question direct. What I do know is that it is at the top of all our agendas. I shall be going back later this week to London, and next week we have our annual board strategy sessions like everybody does, and it'll all be AI. It will be absolutely entirely about that, about whether we can get ahead of this game, and one, take the advantages of it, two, try to ensure that we are appropriately competitive, and three, the defense part of it, because the opportunities for fraudsters to use AI are absolutely massive. The UK can proudly claim to be the banking fraud capital of the world. I'm not totally sure why this is, but it's something to do with the promiscuity of our customers. People are remarkably credulous, actually. And there's more fraud in banking system in the UK than anywhere else in the world. We can absolutely certify this. If you ask HSBC, who run operations everywhere, they say it's far worse in the UK than anywhere else. And this technology can allow people to replicate communications from their banks, and it will be very, very difficult. So I think as we think about the wonderful opportunities of AI, we also have to think about the defensive nature of it. And that's something that we're going to be spending quite a lot of time on. So I hope I've fulfilled the brief, which was an impossible one. I hope I've alarmed you, because that was my intention. And I think as we go on to discuss some of these implications, we'll probably alarm you even further. But I would say that I think that the fuss in the banking system, particularly in March or April of this year, has faded away. And touch wood, I don't think we're facing a systemic crisis as a result of the failures in the US and Europe. Thank you for your attention.
Thank you so much for taking us on a journey in all that has happened in the last 1 year or so. And, you know, I've never heard the UK banking system being described as promiscuous, but that's something that we need to have at the back of our minds. There's a lot to discuss, a lot of ground to cover. And one of the reasons we invited Sir Howard was because he was the inaugural chairman of the Financial Services Authority, you know, taking the regulation of financial services as a whole out of the central bank. And I may be wrong or misspeaking when I say the purveyor of open banking in its early days. So we need to have that at the back of our minds in this discussion. Lots of ground to cover. But before we continue, I'd like to, welcome Theo Priestley. Now, Theo is going to have a keynote specific to the technology track later on AI. But I want to start by adding his little input into this conversation so that we can make it more holistic. Theo, not being a banking person, what are your top of mind thoughts as you come to this conference that you expect to see added into the conversation? Sir Howard brought us to where we are today, and today is the period where Apple just launched its virtual reality, Goggle. It's funny that whenever I see that word, I just stop to think how it's pronounced. And so much is happening on AI that is thwarting institutionalized, businesses. So just a top of mind thoughts, Wes.
Sure, thank you. So first point of correction, I've spent nearly 20 years in retail banking in my career. And I'm older than I look, unfortunately. It's interesting to see what's happening in especially recent trends. I mean, we've lived with AI for a long time. I mean, AI is not a new thing. I mean, even credit lending decisions use an algorithm that take into account people's spending habits. People have Alexa, Siri on their phones and use it on a day-to-day basis. And we've been comfortable with the notion of AI ever since the first science fiction book was written and the first movie introduced it to us as well. So people are very familiar with AI, and in business, it's a level of automation that we've become used to. Where we are right now, however, is that level of automation has become so more sophisticated that it can handle more complex tasks. And looking at the previous keynote, when there was a chart, several charts and several things sprang to mind. One of which is your data, and a lot of banks, and certainly in the fintech trends, were releasing software products like Bank in a Box, where you have a platform made up of different composable softwares that you could create a bank out of thin air, as long as you have the data and the APIs available to it. AI can actually rewrite that entire DNA from scratch. I look at the software industry and the Anderson Horowitz quote there. And I see it being, and stack vendors especially, being obliterated, because you do not need so many different systems, disparate systems that don't talk to each other, if you can actually overlay it with an AI that can complete these tasks. And that accounts to the other fact there that over 50% of the banking organization can be disrupted through this automation. Is because a lot of it is very low level tasks performed by, mid-level educated people who just sit on a computer all day doing digital work. And we've been pushing digital as a trend for the last 20 to 30 years. And of course, digital being the easiest thing to disrupt in white collar work with AI. So banks are going to see huge amounts of disruption, both technologically and resource wise. Two, they're going to face a lot of negativity in the press because of the amount of disruption, certainly in terms of headcount reduction, because that will be the first thing that will happen. And a lot of consultancies, if there are consultancies in this organization, in this room here, the first thing that you will do is probably tell clients the bottom line, remove headcount, and that'll help your profit margins. That's obviously the strongest line to sell services, but it's going to hit banking in ways that it's not hit before.
Something I say in my book is that as I was putting the book together, I came to a point where I said, if the product doesn't change, nothing changes. And then I spent about 1.5 years thinking which of the banking products that is ripe for change. And you'll see this in the book. It was published last year, right? And I said, the deposit business. That's the product that defines the industry. That's the product that you really need to get right if you're going to get your cost of funding in order. And that's exactly the business that is in transition. Okay, now just have that at the back of our minds, and somewhere in this conversation, I hope it comes through. But at this point, let's get a comment from Barney Frank,